Imagine this scenario. You are playing a high-stakes game of poker. You have the best hand at the table, you have calculated the odds, you have bet heavily because the math is on your side. You go to sleep confident that when the cards are revealed in the morning, you will sweep the pot. But then, you wake up, you check the table, and your chips are gone. Not because you had the wrong cards, not because the other player bluffed you, but because at 3 a.m. while you were sleeping, the casino manager walked over to the table and changed the rules of the game. He decided that an ace is no longer high. He decided that your bet size was illegal, and he forcibly took your chips to protect the house. This sounds like a nightmare. It sounds illegal. But in the world of commodities, futures trading, this is exactly what happened this morning. Every year, thousands of traders wake up to discover their positions have been liquidated overnight, not because the market moved against them organically, but because the exchange changed the leverage rules in the middle of the night. Right now, as I record this on Monday morning, December 28th, silver traders around the world are staring at screens flashing red. Their positions are being forcibly closed, the price is collapsing, and billions of dollars in wealth are being transferred from the retail sector to the institutional sector in the blink of an eye. If you are trading commodities, futures, crypto, or any leveraged instrument, what I am about to share could save you from financial devastation. Because today, the victim is silver. Tomorrow, it could be your entire portfolio. This is Veiled Wealth. And today, we're going to expose the mechanism of the margin trap, why the $75 strike price terrified the banks, and how to bulletproof your wealth against a system that can change the rules whenever it starts to lose. Welcome back to Veiled Wealth. To understand the magnitude of the theft, and I use that word deliberately, we first need to survey the damage. Let's look at the actual numbers from this morning's market action, because this is real money being lost by real people in real time. The session began with optimism. Silver has been in a structural bull market. The fundamentals are screaming higher prices. Solar demand is up, electronics demand is up, investment demand is frantic. Shanghai silver opened the session at approximately 8,602 yuan. When you convert that, it's roughly $88 per ounce. The bulls were in control. Then the trap sprung. Within hours, the Shanghai price crashed to 7,180 yuan, around $79. That is nearly an $8 drop in a single morning session. In the world of physical commodities, an $8 move is not volatility. It is a crash. It is a liquidation event. Over in New York, the Comex followed suit. Silver opened around $80.50 per ounce. It didn't just drift lower. It plunged to $75.68. We are watching a 5 to 6% crash happening live. And here is the most critical part of this investigation. It has absolutely nothing to do with supply and demand. There was no news report stating that a massive new silver mine was discovered. There was no news report stating that solar panel production has halted. The economic fundamentals at 8 a.m. were exactly the same as they were at 3 a.m. So, what caused the crash? The catalyst was a single notification sent out by the Chicago Mercantile Exchange, CME, the parent company of the Comex. They raised the margin requirements. Previously, to control one contract of silver, you needed to post $22,000 in collateral. Overnight, they raised that requirement to $25,000. That is a 13 to 14% increase that traders must meet immediately. Think about the logistics of this. You are a trader. You're holding 10 contracts. You're fully invested. Suddenly, you get a notification that you need to deposit an extra $30,000 into your account. Not tomorrow, not next week. Today, by the market open. If you don't have the cash sitting idle, if your bank transfer takes too long, if you are sleeping, your broker doesn't care. The algorithm doesn't care. The broker automatically liquidates your position. They sell your silver at market price to cover the new margin requirement. Now, multiply that by 10,000 traders. 10,000 sell orders hit the market at the exact same second. The price drops. The lower price triggers stop-loss orders for other traders who weren't even affected by the margin hike. Those stop losses trigger more selling. The price drops further. Now, traders who did have enough margin suddenly don't have enough margin because the value of their position has fallen. They get liquidated too. This is called a liquidation cascade. It is a man-made avalanche, and it was triggered intentionally by the very people who claim to provide a fair and orderly market. Before we go deeper into the why, we need to fully understand the how, because this same tool exists in every market you trade. Margin is essentially a security deposit. It allows you to control large positions with small capital. This is leverage. One silver contract represents 5,000 ounces. At $80 per ounce, that contract is worth $400,000. But you only needed $22,000 to control it. That is roughly 18x leverage. It's a powerful tool for wealth creation, but it is a fragile tool. Here is what most retail traders do not realize, and it is printed in the fine print of the user agreement that nobody reads. The exchange can change margin requirements whenever they want. They do not need your permission. They do not need to give you a 24-hour warning. They can do it intraday. Why does this matter? Because it means the exchange has a kill switch for any rally. If the price of a commodity gets too high, if it starts to threaten the stability of the banks who are short, the exchange can simply raise margins. They say it is to reduce volatility, but in practice, it is a tool to decapitate a bull market. It forces the weak hands, well, the retail traders operating on high leverage, to sell their positions to the strong hands, the institutions who have billions in cash reserves. The institutions know this. They expect this. When the margin hike announcement hit the wire, the institutions didn't panic. They waited. They waited for the retail liquidation to smash the price down to $75, and then they started buying. They are picking up your positions at a discount using the very volatility the exchange created. Now we arrive at the core of the veiled wealth investigation. Why now? Why raise margins on a Monday morning in December? Why not last week? Why not next month? We don't believe in coincidences. We believe in incentives. When prices drop due to forced liquidation, short sellers benefit enormously. Short sellers are traders, often large bullion banks, who have sold contracts for silver they don't actually own. They profit when prices fall. But recently, silver has been rising relentlessly. The shorts were bleeding. They were facing potentially catastrophic losses. But there is a specific number that terrified them: $75. According to reports from financial data analysts, including the Hindu business line, there was a massive accumulation of call options at the $75 strike price. There were approximately 41,000 contracts betting that silver would go above $75. Let's do the math on that. 41,000 contracts. Each contract is 5,000 ounces. That is 205 million ounces of silver. Here is the nightmare scenario for the banks. If the price of silver stayed comfortably above $75 leading into expiration, those options would be in the money. The holders of those options, industrial users, hedge funds, sovereign wealth funds, could theoretically exercise those options and demand physical delivery of the metal. They could say, I don't want cash. I want my 205 million ounces of silver. There is a problem. There isn't enough readily available registered silver in the Comex vaults to deliver 205 million ounces. The vaults are running thin. The physical market is tight. If 205 million ounces were demanded for delivery, it would trigger a delivery default. The exchange would break. The banks would be insolvent. The price of physical silver would decouple from paper and go vertical to $100, $200, or beyond. This is called a short squeeze. It is the event that every silver stacker dreams of and every central banker fears. So look at the timing again. Silver was trading at $80. It was dangerously above the $75 strike price. The delivery threat was real. Suddenly, margins are raised. Liquidation cascade ensues. Where did the price drop to? $75.68. It was smashed right back down to the critical line. By forcing the price down, the exchange reduced the pressure on the shorts. They shook out the leveraged longs who might have demanded delivery. They cooled off the market just enough to prevent the system from breaking. Is this manipulation? Legally, probably not. They have the right to change margin. But functionally, it is the system protecting itself at your expense. They burned the village to save the castle. There is another piece of evidence that proves the market is broken: the spread. In a functioning global market, the price of silver should be roughly the same in New York, London, and Shanghai. Arbitrage traders ensure this. But yesterday, the price difference between Shanghai and New York reached $8 per ounce. That is historically unprecedented. An $8 premium in Shanghai means that physical metal is in desperate demand in Asia. It means the real price of silver is much higher than the paper price in New York. The West is trading paper derivatives. The East is trading physical metal. The margin hike this morning smashed the New York price down, but it also compressed the spread to about $5. What does this mean? It means the forced selling on the Comex artificially lowered the Western price, but it didn't solve the physical shortage. Factories in China still need silver. Solar panel manufacturers still need silver. The physical demand hasn't gone away just because the CME changed a rule. This suggests that this price drop is temporary. It is a paper event in a physical world. Once the liquidations are over, once the weak hands are washed out, the physical reality will reassert itself. The price will likely snap back violently to close the gap with Shanghai. The spring has been compressed, not broken. Let's step away from the math for a moment and talk about the psychology, because this is where the wealth transfer actually happens. It happens in your mind. The goal of a forced liquidation event is not just to lower the price. It is to break your spirit. Traders who got liquidated this morning are traumatized. They watched months of gains evaporate in minutes. They feel cheated. They feel stupid. They will hesitate to re-enter the market. They will sit on the sidelines, paralyzed by fear. This is exactly what the smart money wants. They want you to sell at the bottom. They want you to leave the market so they can accumulate positions without retail competition. This happened with silver in 1980. It happened with oil in 2008. It happened with Bitcoin in 2017. The playbook repeats because it works. Retail traders use maximum leverage and minimum caution. Institutional players use deep pockets and maximum patience. The Hindu Business Line reported a warning that traders found in their accounts. If investors do not have the required amount in their accounts by Monday, their positions will be liquidated. That message is the sound of the door slamming shut. If you are relying on a broker notification to save you, you are already dead. So how do we fight back? You cannot stop the CME from raising margins. You cannot stop the banks from shorting. But you can make yourself unkillable. Here is the Veiled Wealth protocol for surviving a rigged game. Rule number 1, the 200% buffer. Never, ever trade at minimum margin requirements. If the exchange says you need $25,000 to hold a position, you should have $50,000 to $75,000 in that account. Yes, this reduces your leverage. Yes, you will get rich slower, but you will survive. When the margin hike comes, and it always comes, you will get a notification, you will look at your excess liquidity, and you will go back to sleep. While others are being liquidated, you will be holding. Rule number 2, position size for the worst case. Before you open a trade, ask yourself, if margin requirements doubled overnight, would I be liquidated? If the answer is yes, your position is too big. Size down until the answer is no. We are not gamblers, we are risk managers. Rule number 3, acknowledge regulatory risk. Most traders only model market risk, the price going down. You must model regulatory risk, the rules changing. The rules are not static. The exchange is not a neutral referee. It is a player in the game with its own survival instincts. Bet accordingly. Rule number 4, watch the options calendar. We saw the 41,000 contracts at $75. That was a giant red flag waving in the wind. When you see massive open interest at a specific strike price, expect turbulence around that number. The market makers will defend that wall. Do not place your stop losses right at the strike price. Give the market room to breathe. Rule number 5, diversify jurisdiction. Do not keep all your commodity exposure in Comex futures. If the Comex breaks, you are trapped. Spread your exposure. Hold physical metal in your own safe. No counterparty risk. Hold ETFs that are backed by metal in different vaults. Trade on different exchanges if you can. If one exchange changes the rules, you need assets that are out of their reach. There is one wild card left in this deck. The industrial users. We talked about the 41,000 option contracts. Most traders settle for cash. But what if the holders of those options are Samsung, Tesla, or Jinko Solar? These companies don't want cash. They need silver to build products. They have the warehouses. They have the logistics. If even a fraction of those contracts are held by industrial players who decide to stand for delivery, the margin hike won't save the shorts. You can raise the margin to $100,000. If Tesla needs silver, Tesla will pay it. This is the scenario that keeps the bank risk managers awake at night. A commercial signal failure. The moment when the paper tricks stop working because the physical need is too great. We are getting closer to that moment every day. The narrowing spread between Shanghai and New York suggests the physical market is tight and getting tighter. The drop we saw this morning was brutal. It was unfair, but it was entirely predictable. Markets are not democracies. They are battlefields. And on a battlefield, the general can change the strategy whenever he wants. The silver market will stabilize. The physical shortage is still real. The fundamentals that drove silver to $80 haven't changed just because the margin is higher. But thousands of traders won't be around to see the recovery because they were liquidated this morning. Don't be one of them. The wealth transfer is happening right now. Are you the one transferring wealth, or are you the one receiving it? Learn the mechanism, respect the leverage, and never trust the rules to stay the same. This is Veiled Wealth. We don't just watch the price, we watch the game. Stay liquid, stay safe, and remember, if you don't hold it, you don't own it.